agent I had on the other day, that's literally all we talked about is the people that are required to sell now, people that have new jobs, growing families, loss of life.
The good news is...
Hey guys, welcome to another episode of Break It Down with Braydon. Today I got Tina Tamboer on with me today. Tina, thanks for joining.
Oh, my pleasure. Thanks for having me.
Of course. Tina is with the Cromford Report and kind of the statistician, economist, real estate expert in the Valley around town, if you would.
Oh my, yes. A little bit of everything there.
Yeah, I think every title company, lending company, and real estate company in town probably has heard the name Tina Tamboer, and if they haven't, they've been living under a rock over the last 5-10 years, and kudos on you for kind of creating the name around town and kind of being that source of information.
Well, thank you. I am absolutely grateful for all the support we've gotten over the last decade, for sure, from the real estate community, from title companies, lenders, real estate agents, especially in the MLS. We're just very grateful that that we were able to be here during times of uncertainty. You know? Normally, we're just under the radar. It's not until things become a little uncertain, a little volatile, that we start bringing the analysts out.
Yep. Definitely helps right now.
That does, absolutely.
Give everybody a little bit of background on the Cromford Report and kind of how it started and how it got to where it is today.
Oh, gosh. Well, the Cromford Report was started by Michael Orr. He's a mathematician from Oxford. He came out here from California, Silicon Valley, and he started investing in homes and realized that he didn't have any good tools. So he started pretty much downloading the MLS without permission. And it kind of evolved into something he started giving to his friends, then selling, and then he got a cease and desist from the MLS going, you're not really allowed to do that. But right around the time that happened was when the bubble and then the crash was occurring. So right around 2007, 2008, the MLS said, hey, we don't really want you selling it like that, but if you could just provide it for our members, we'll be happy to accommodate that.
Yep.
So that's how he kind of got started and went through, of course, all of those years, 2008 through 2011. I came on right around 2011 with him, and the MLS decided they were going to go with a different product. So we went independent, and that's where
that was 2011?
In 2011, actually 2012 to be exact.
Okay.
Mike started off with ASU. He started that little side business there, if you will, but he's always been a part of the Cromford Report, and then I just took on the presentations for him. But he's still very, very active.
Okay.
He works out of England now, and he writes a lot of our commentary, most of our commentary on the website, and he maintains a lot of the data.
Oh, like the daily observations and stuff, is that
Daily
him?
Observations are often Mike. Some people think that's me.
Yep.
And I'm like, I don't use some of the words he uses. He's British. We don't say boot for trunks and stuff like that.
Yep.
But no, he still keeps up with it and is very, very active and interested in the Phoenix market.
Yeah. So your day-to-day then is mostly all the classes, all the CEs, and all that different stuff?
I don't really do
not
CE.
Not CE, but all the different classes.
Yeah.
Yep.
So basically the 1.5 hour updates, 5 times a week.
Yep.
Pretty much 5 to 8 times a week sometimes. But I would say that the demand is very high at this stage because everything is shifting and changing pretty much on a weekly basis.
Yep.
And it's just a point of comfort for a lot of agents to be able to give their clients good advice, up-to-date advice, or even not even advice, just information on what's happening so they can make a better decision or a confident decision in their purchase or sale.
Yep. Yeah, I get people on here all the time, and they're always kind of regurgitating, quite honestly, the stuff that you're saying, and then we get people all the time that are commenting, and the naysayers or the people that are super negative on the market or always just looking for the negative news and things, if you would. And so I'm excited to have you on to kind of give a little bit more statistics behind it and kind of facts behind it, because that's all you're looking at. You're looking at the numbers all day, so it's not like you're giving you are giving your opinion, but your opinion based off of the numbers that you're looking at and the data.
Yeah. And of course, during these times where we have leading indicators and trailing indicators, and when your leading indicators are showing a positive say positivity for price or for sellers, but all of your trailing indicators, which will be sales or quarterly reports and things like that, start reflecting what you've just been through, which was quite negative. When those two don't match up, you get a lot of skepticism in the marketplace. And so as an industry, we like to look towards the optimistic side of things, but then our clients might be coming in and going, what about this?
Yep.
You know,
I saw this in them. Yep.
I know, right?
I just saw this. What about this?
Yeah, exactly. Yep. And then you're like, well, we already lived through that. So I'm like, I'm looking this way. I'm not going to look that way. But, you know, and sometimes small improvements in the marketplace can be seen in different ways. Like some people won't see that as a positive. It's not positive enough for them to change their view that, you know, we're going to be like this forever.
Yeah. I think it was 2 Fridays ago, I was sitting through one of your classes, not one of your classes, but just you were giving a speech during the West USA Awards ceremony.
Yeah.
You talked about how there's negative 49 listings going on, or we're losing 49 listings every day on the market right now, and that's kind of the biggest factor right now is the inventory issue, and there's just not enough houses coming on the market.
Absolutely.
Can you maybe talk a little bit about that?
Yeah, I think that some people are confused when they look at the annual numbers showing that we are up 135% over last year for supply, and then saying, how can you be telling me then that I'm losing this opportunity right now? And that's because they don't realize we were up over 300% in supply, and it is dropping extremely quickly. And a lot of that surge of supply was from flip investors, iBuyers, specifically Open Door. Also, you had your new homes coming in because they weren't selling, so they decided to put them on the MLS. So we had this massive surge last year of supply that peaked in October. But since that, we have come down now 39% from the peak, and we're dropping very, very quickly, which means that that was an opportunity for buyers to have a lot of choice, and now that choice is diminishing every single day, and they might find themselves pretty soon without as much as they have now. Yeah. you know, if you have some, criteria that the home at least be clean, be working properly, you might be seeing those types of homes going very quickly, and you might find yourself looking at a home that's not so perfect.
Yeah. You talked about iBuyers. Talk a little bit about kind of what the iBuyers are doing right now.
iBuyers, this is not a market for short-term holds right now. And so the iBuyers and pretty much any short-term hold investor is going to be very, very conservative, because we're still at the beginning stages of another seller market, but it's a very mild one. And they're still kind of nursing their wounds from last year. So I'd say the iBuyers right now, in August, they were about 12% of all of our MLS supply. Now they're less than 3%. They're only acquiring maybe 20 to 30 properties a month, if you're lucky. And they're selling over 200 to 300. So they're just diminishing their own supply, and they're not really taking on anything new. So that is opening up an opportunity for long-term hold buyers not having to compete with that kind of investor claiming cash and, wooing those sellers away from you. And you're like, we don't need to do repairs. They don't require repairs, things like that. So like I said, this is the market for buyers that do need concessions, and that's, seller paid closing costs. Sellers are more than happy right now to pay closing costs. They expect it in many situations now. So that's not a hard negotiation. They are not as hard lined on their list price as they were a year ago. They are
willing to make some repairs.
They'll do repairs. They're more open to, say, replacing air conditioners, things like that are 30 years old.
Right.
And that is, while you might see the mortgage rate as a downer, you might see the, sometimes the condition may not be what you expect, but the opportunity is definitely there, because if you were to see that home go away and nothing else come on, then you might start to feel some regret. And over the last week, we have 2 weeks now, we're starting to see buyers coming back, even with the rates where they are in the mid-sixes. The buyers are just watching that inventory go down, and they're like, well, I guess the rate is what it is, and I better get a house now.
Is there a sweet spot for rate that you're seeing? Like if it gets to a certain point, like buyers are coming in, or is it?
The mid-sixes. The mid-sixes, well, the rate buy downs are still a massive part of our demand and the massive part of why we are in a seller's market. for that matter. So without those, and the median right now is about $9,000 in cost to the seller. So without those, we probably wouldn't have the demand. But with them, it keeps the fluctuations, people popping in and out of the market based on market mortgage rate fluctuations.
Yep.
It keeps that to a minimum because, a 2-1 buy down, they're not seeing, say, 6.5%, they're seeing 4.5%.
Yeah.
And a fluctuation up or down from 4.5% still feels better.
Yep. Yeah, I was talking to a client yesterday that she got her client concessions, got them a permanent buy down on the rate, and as well as the 2-1 buy down, and got them into like the low 4s. And so
wow, that's pretty amazing.
It's still,
that's
pretty good opportunity.
absolutely
out there if you
amazing.
like that.
But that's going to last for as long as we have people who have equity.
Yep.
So in terms of equity, the people with at least 2 years of ownership are going to do okay.
Yeah.
But once we start getting through all the people who have owned for longer than 2 years, if you only have short-term hold people, then they're not as able or willing to do that.
Yep.
But for as long as we have sellers that have plenty of equity, which we do right now, and have the ability
still get the tax-free gains and
well, I don't know about the tax part, but as long as they're looking at something like, okay, I can handle this return on my home.
Yep.
Many of them, especially if you've owned it for 6 years or 7 years, you're looking at 86% appreciation on your home, possibly.
Yep.
So, a few $1,000s here or there isn't going to kill your bottom line for what you need to take it to the next home. And then, of course, as the seller who's going to then buy again, you're thinking, well, hopefully I'll get that on my buy side, right? So it all turns into a wash. But overall, the industry, I think where the confusion comes with skeptics coming in, watching our prices go up and not understanding why are the prices going up. That doesn't, when we're seeing sales as low as, 2008 in some cases.
Yep.
The thing is that there's a difference between what a buyer and a seller experiences in the marketplace today and what an industry professional experiences today. So as we all know, the industry has grown over the years to accommodate way more transactions. And so that's where we've been seeing the shrinking. That's where a lot of the influencers online point to.
Yep.
And even Goldman Sachs pointing to that.
Yep.
But without knowing what the supply was back then, it's not really comparable.
Yeah.
I mean, the amount of supply we have today versus 2008 is...
At the height, what was our supply?
At the height, at the end of 2007, before the 2008 crash, we had 57,000 listings in the MLS.
And we're at like 12 now?
Yeah, we're at 12,000.
Yeah.
Yes. So you take, slightly more under contract today than in 2008, of course.
Yep.
So a little bit more under contract, but still below normal, but way below normal on what we should have.
Yeah.
And 57,000 was way above normal, ridiculously high.
Yeah.
And we should be in a normal market, which we haven't had for a long time, but we would expect like 20 to 24,000 listed.
Okay.
And we're at 12. So we're about 42% below normal for supply. We're below normal for demand, but only 18% below normal for demand.
Okay.
And demand is actually rising now.
Yeah.
Believe it or not.
What about new build permits?
New build permits dropped like 73% from March of last year to December. And over the last couple of months, they're popping up a little bit, but they're as low. Just to give you an idea, like the lowest we saw permits was right after the 2008 crash. So starting from 2009 all the way to like 2013, 2014, very low permitting. In fact, that's what they were blaming for the shortage that we have today, because we started growing in population and we just ate up all of that excess.
Yep.
Well, we're now at a permitting level that is as low as 2014. And I mean, it plummeted. So we're not really seeing any relief in our supply from the new construction.
Yep.
We're not seeing any relief in supply from, say, Open Door buying a bunch of homes and throwing them back on the market for us. That's not happening.
Yep.
And so all that's left is what we call a churn, which is sellers and buyers moving within the metropolitan area.
Yep.
Most of them are staying put. So that leaves us with the people who absolutely have to sell.
Yep.
Yep. So
agent I had on the other day, that's literally all we talked about, is the people that are required to sell now, people that have new jobs, growing families, loss of life, or whatever.
The good news is that they will sell their home.
Yep.
The tough part for them is that they'd have to give up their sub 3% mortgage rate, but in many cases they've earned enough down payment from the appreciation of their home that they may be able to just get their loan down far enough to where their payment at least is not as affected.
Yeah, it seems like a lot of people too will just rent out that one too if they've got some equity they could pull out of that one to go purchase another one and use the rent to offset the new mortgage or whatever.
Yeah, that does help us get through the 5 stages of grief.
What's some of your predictions?
Oh gosh, predictions. It's very difficult to do a prediction outside of what your leading indicators can see right now. Okay. So all of our leading indicators give us about a 2 to 3 month advance notice of any shift in price. And I can tell you that we're not seeing any shifts in price. We're expecting to see that price continue to rise for we're in at the end of April now. So May, June, and into July, we're most likely going to see prices continue up. And that means when you start looking at year over year, our prices started dropping after May, but significantly after June last year. Yeah. So once we get to the July versus July annual appreciation rate, it could very well be positive at this range. Yeah. So, but this is one thing I can predict that's out there right now is the Case-Shiller index was released recently, and Case-Shiller is just like right now, whoa, we're negative year over year in Phoenix. Like they're just figuring this out, right? Because they are a 3-month moving average and they're released 2 months late. Got it. So the Case-Shiller was released for February, which is February, January, December. And those 3 months, December was declining, January was coming into balance and stabilizing, and February was appreciating. And so the Case-Shiller is now just telling us what we've already been through. Yep. So we can now predict what the Case-Shiller is going to be. So I would say the Case-Shiller is going to start showing a stabilization in their next measure and then an increase in their next measure, which will be for April, right? Which will be, we're already going to be far enough ahead of them. Yep. So they won't start reporting what we are seeing right now until November. So we can pretty much say the Case-Shiller is going to be hitting bottom right now, and then you're going to start seeing an improvement. Makes it easy for those of us who have already lived through March and April.
Yep. Let me actually open up your website real quick. I want to pull that up. So for somebody on here as an agent looking for content, kind of what they should be looking at, what do you kind of recommend them kind of looking at on a daily basis?
Okay, well, if you don't have a subscription, you can always scroll down to the 3 dials right there. Yep. That is updated every single day. So just to read this from a color standpoint, green is good for a seller, red is bad for a seller. It's always about appreciation. Anything good for a seller is good for appreciation. So if it's in the green, that means we're in an appreciating market. Okay. On the supply and the demand indexes, 100 would be normal for this time of year. So when we look at demand, we'll round that up to 83. So we're 83% of normal for demand, so we're 17% below normal. Got it. Supply at 100 would be normal for this time of year. We're at 57, which means we're 43% below normal for supply. So that means that because the supply number is lower than the demand number, that's pushing the market towards sellers. So even though demand is low, supply is even worse, and that puts sellers in an advantage in this marketplace, and you're going to see prices go up.
So for people that don't subscribe to the Cromford Report, they could go to this actually and just see this every day?
Yeah, absolutely.
Didn't know that.
Yeah, you can.
Cool. I always look at the daily, I think it's the daily observations. Yep. Mm-hmm. Is there anything else that you recommend kind of people? Obviously, there's tons of information on here, but something to look at kind of daily or anything like that?
I would say that many times people get in here and they're not just curious about what the market's doing. They actually have a client that they have to answer questions for. Yep. Or they're going into a listing presentation or a buyer presentation. So under the dashboards, which is up a little bit, down a little bit, right there. Yep. Yeah. There's a market conditions dashboard. I'd say this is my favorite one right now, and I usually use the price range filter. Square footage is for the that home that's a little outside of the norm.
Got it.
If you will.
Okay.
Over 10,000 square feet or something.
Yeah.
What this basically tells your sellers or your buyers is how many contracts are being accepted every week in their price point and their area, what the median days on market is, and the third one down is where the list price at contract is.
Got it.
So where that sweet spot, where the buyers are writing their contracts. Now you're going to have listings that are above normal and listings below normal. These are just averages, but it's showing that it's rising.
Yep.
So that tells your buyer, if you're seeing the list price at contract rise, it's not a declining market right now.
Yep.
And it also lets them know how many buyers they're competing with on a weekly basis for their price point and their area. And same thing for sellers. It kind of sets an expectation. And if the sellers are seeing this list price at contract moving down, which it might be in some areas,
yep.
that tells them maybe don't push the price too much, don't push the market, you know?
Yep.
The second thing that you could pair this with is also in dashboards, and it's the listing presentation dashboard. So between these two, you can answer pretty much any question a seller has. This just tells you what supply is doing.
Got it.
So notice that this one defaults to single family homes, so it's a little lower than the supply count I gave you.
Mm-hmm.
We only have just under 8,900 valley-wide single family homes for sale. So, and it also tells you how many are sold. And then the last one is a 6-month moving average on the price. That lets you know last year you would have been paying over list price, but this year you sell. Yeah, that's a negotiating gap.
Got it.
So it lets them see that, okay, we're probably going to be getting an offer that's not going to be your list price in this marketplace.
Cool.
So between asking about how many competitors do I have, that's the supply for the seller. How many contracts are being written every week, that's on the other one.
Yep.
Plus the days on market, plus the list price at contract. You're going to answer just about all your questions with these two sheets.
Love it. Yeah, huge resource.
Mm-hmm.
Yeah.
This one's updated every day.
Okay.
The other one's updated every week.
Okay, love it. Yeah, obviously this is probably the number one resource for actual stats in the industry, I believe, at this point. And so,
that's good to know. I feel very proud about that.
You should.
I don't know that there's an actual ranking, but I guess if we could,
we'll make it up, and we just ranked it number one.
I'm gonna go with it.
Yeah, we
I'll
just
be like,
it.
I'm number one, even if I'm the only one in the list.
Another thing I want to talk about was short-term rentals.
Oh yeah.
Yeah.
Okay.
Talk a little bit about those. Kind of how those have impacted the market here.
Well, short-term rentals are kind of what. For us, we don't have a good resource for short-term rental data.
Okay.
The reason for that is that because there's no regulation, not to say there won't be regulation, but there's not a data source that we can pull from right now that says these parcel numbers are short-term rentals for this amount of time, for this much of the property, you know, for these times a year or whatever. And so that makes it very difficult because that supply can fluctuate up and down incredibly fast.
Yeah.
And so we usually
events in town or whatever.
Like we refer to AirDNA,
mm-hmm.
Which is also not a perfect resource because they scrape the websites.
Got it.
And the websites will not give address information or any kind of parcel information, and certainly not address until you go 3 or 4 layers deep into the reservation process.
Yeah.
So while that is less than perfect, we still use what we can. So AirDNA has, again, they're also national, so that helps us compare our neighborhoods to other neighborhoods. So what we can say is that the occupancy rates per AirDNA's research in Scottsdale, Paradise Valley, and Phoenix are all lower in the 60 percentile compared to some of the cities we like to compare ourselves to, like LA, Denver, and San Diego.
Got it.
They're all in the 70 percentiles. And so what that tells us is that there are some short-term rental operators out there that had a disappointing season. And they may or may not keep that place. And they may or may not be able to sustain themselves on that investment if it's not occupied more.
Yeah.
So as a result, we have seen some circumstantial evidence. Okay, since I can't directly correlate, I can take circumstantial evidence and say we have seen a spike in Scottsdale in long-term 12-month leases available for lease.
Switching them over.
Yeah, very, very sharp, in fact. And a lot of them in 0 to 1 bedrooms, so the studio 1 bedrooms up for lease, and also 5+ bedrooms. So again, the spike on 5+ bedroom rentals is in Scottsdale and Gilbert primarily. Okay. And so we can take that and go, we can also take the median rental amount, the median lease that's successful and watch that going up, and also notice that we have quite a few furnished going on. So when you have a furnished rental where like the foosball is included,
right.
you know, it's like all of that fun stuff that they have in there, you can see those getting rented long term, and you actually see your lease price moving up because
and you get the 4 queen bunk beds.
Yeah, exactly. Yeah, exactly. So, I mean, a lot of that circumstantial evidence kind of tells us that if they cannot put a short-term tenant in, they turn it into long-term. If they cannot get a satisfactory long-term tenant, it could potentially give us some opportunities for properties for sale. And the big question is how much? Will it be enough, frankly? Or will it be another little blip in the radar where buyers get a little, opportunity to pick up a home that's in really good shape? Or, mild use, if you will. No big parties are done in these houses or something like that.
Probably some pretty cool amenities in the backyard.
Possibly, yes. Some cool murals have been painted out there. But the thing is that there may be a little bit of that boost towards the end of our peak season for tourism, and we'll just have to see if that pans out, frankly.
One of the slides I saw through one of your presentations kind of talked about some of the hot markets for short-term rentals, and I was surprised that some of them weren't kind of the Scottsdale, Paradise Valleys. What are some of the...
Oh, well, we have hot markets for luxury. That might have been part of it, too. So in terms of hot markets I don't do a lot of, like I said, I don't hang on to the short-term rental a whole lot. I let Airbnb do that. That's their thing. But as far as luxury goes, though, which is again associated a bit with short-term rentals because so many of them are business models now, right? Yep. But if you look at the supply of homes over $1 million in the Northeast Valley is not enough to satisfy a lot of the people coming in with these big budgets, these high-end buyers. They're not going to get what they're looking for in the Northeast Valley if they're in the low 1 millions, for instance. Yeah. Now, I still consider $1 million a lot of money,
right.
But you get into the Northeast Valley, they're like, that gets you a tract home now.
Yeah. Congratulations.
Right. Maybe a nice condo with a shared wall, whatever. So if that's not what you're looking for, then you're going to have some spillover. And so spillover is happening in the northern Peoria area, 85383, just west of where the Taiwan Semiconductor plant's going in. Okay. And that area has definitely seen a frenzied, a lot of very good ratios going on between what's active and what's under contract in northern Peoria. Okay. We're also seeing it in Northeast Mesa, and we're seeing a lot of it as well in Chandler and Gilbert. So those are some areas where we're seeing this spillover of people with high-end budgets, and they're not getting the product that they want in the Northeast Valley, so they're coming into other parts of the valley, and Ahwatukee is another place. So they look for things like hillside lots, city light views, big lots, big houses possibly, or just highly renovated or highly updated homes.
Yep. Yeah, I got a friend texting me from Seattle that wants to move out here, and he's like, well, I was looking in Scottsdale, but now I'm thinking Gilbert because I want a pickleball court in the backyard, and I need a pool. And I'm like, yep, that's not Scottsdale.
Yeah, if you want land, if you want a big lot, you're most likely going to be looking out in Gilbert or Queen Creek or Peoria and Chandler.
It seems like there's a big migration to Queen Creek.
Well, that is where you're going to have a more choice. There's a lot more new home development going on out there. It's more of a balanced market. Queen Creek just moved out of a buyer's market into balance. Doesn't really affect the luxury market. They're not affected by interest rates and things like that. But as far as choice and the newness of the product, you're going to be a little happier with Gilbert because in Scottsdale, their big building boom was in the 90s. For Scottsdale.
Gotcha.
80s and 90s.
Yeah. All the Greyhawks and the DC ranches and all those, north of Pima or whatever.
Yes, absolutely. Yeah, I think Kierland just was coming about like 24 years ago.
Yeah.
Right around 1999.
Yeah, I was living on Cactus when the 101 was built, so I remember the boom of all that stuff.
I remember Cactus in the 90s when it was still a dirt road after Pima.
Oh, yeah.
And Pima Freeway was bridges to nowhere for a long time. So, yeah, we've come a long, long way in the last 30 years. It's pretty incredible, frankly, to be for it.
Before we leave, Tina, kind of give everyone a last little tidbit on Arizona's market. Just kind of leave everybody with a little tidbit.
Oh, I think Arizona is, and I'm not coming at this from a biased standpoint. I have been here since 1993, and I've watched a lot of the market. I started out with a title company actually as a programmer and their sales department. So I've watched the growth and the seasonality. And what I've seen about this city is that we're still the little sister of all the big cities, right? We're like, look at us, we're still growing. Everybody else is
come here.
I know, look at me. Oh, I'm sorry you're having a hard time, but look, we're brand new. And so the thing is that we have been stabilizing, even though we were not stable in things like our industry base or our talent base. We used to have what they called brain drain. And brain drain is where we would educate them and then they'd go off somewhere else for the jobs. And so over the last going on 13 years now or longer, the Greater Phoenix Economic Council has done an amazing job of bringing in different types of industries to keep the students here. So they come here for school and then they stay here for work. And so that has really paid off tenfold because now the corporations are coming here and they're just drawing right out of the universities. Like Taiwan Semiconductor, I read an article said that ASU can't pump out enough engineers to satisfy that company. They'll suck them all out and then still need more. So I expect that our economy is going to continue to stabilize and we're moving towards high tech, a little less of the cyclicals like real estate, construction, tourism, and retail, and more towards manufacturing,
microchips,
medical, biosciences, all of those that, may need. As our market goes up and down, these industries are more stable and they can pick people up that way. So I believe that we are going to have a less of an issue with this upcoming recession, if and when it's ever called, than we had when the last recession hit us.
Cool. Tina, thank you very much for coming on.
My pleasure.
Yeah. Tina Tamboer with the Cromford Report. Make sure you check out the website. Reach out to her. She's just an amazing resource. She can help you all of your classes and just really be informative for your clients and just a phenomenal resource. So, Tina, thank you again for coming on.
Thank you.
And thanks for sticking in for another episode of Break It Down with Braydon, and stick around. More to come. Thanks, guys.